Hello, everyone. Today we're going to talk about embedded finance, which is designed to streamline financial processes for consumers, making it easier for them to access the services they need when they need them. Next slide. Embedded finance is the use of financial tools or services such as lending or payment processing by a non-financial provider. It is the placing of a financial product in a non-financial customer experience journey or platform. Think of the time that you wanted to purchase an electronic gadget, and at the time of purchasing for that item, which is the point of service, the cashier offered you insurance to protect that item. And it was just easy to say yes or no. And if you said yes, the cashier just purchased that insurance for you. It is also designed to streamline financial processes for consumers, making it easier for them to access the services they need when they need them. With embedded finance, consumers can make a purchase and get credit in one place, which is the point of service. An example of embedded finance is when a store offers point of service insurance during the checkout process when goods are sold in store. Next slide. For decades, non-banks have offered financial services via private label credit cards at retail chains, supermarkets, and airlines. The next generation of embedded finance is so powerful with the integration of financial products into digital interfaces that users interact with daily. Integration of financial products into digital interfaces that users interact with daily, such as customer loyalty apps, digital wallets, accounting software, and shopping cart platforms, are some forms of these types of digital interfaces. For consumers and businesses using these interfaces, acquiring financial services becomes a natural extension of a non-financial experience, such as shopping online, scheduling employees to work shifts, or managing inventory. The estimated market value is over $138 billion in 2026, a phenomenal growth trajectory. Next slide. The evolution of embedded finance has been enabled by fundamental changes in commerce, merchant, and consumer behavior and technology. The digitization of commerce and business management has massively expanded opportunities to embed finance in non-financial customer experiences. Embedded finance is likely to emerge in any environment in which a critical mass of end customers, which are consumers or businesses, have frequent digital interactions with the operator of the digital platform. Next slide.
So there are many uses of embedded finance. The first one that we're going to look at is the buy now, pay later. So buy now, pay later allows customers to receive their purchased products immediately by signing up for installment payments free of interest, which avoids high fees from credit cards. For retailers, they don't finance the purchase themselves, but rather redirect consumers to a third-party financing institution. This gives access to a wider range of products that can be paid over time and empower consumers to shop in a different way. And some of examples of this include Amazon and Samsung. And then next one that we're going to look at is point of service embedded payments, which connects users directly to a company by saving a payment method that can be used later by the click of a button. This encourages digital buying as consumers don't have to go and take out their credit card and enter all their information at the point of service. And one example of where this can be seen is the use of the Starbucks app. Consumers can scan their app at the drive-thru or at the counter. They can pay ahead without having to take out their credit card. And at the same time, they can earn rewards for the purchase that can be used at a later date. Next, we're going to look at the integrated insurance services. So integrated insurance services allows users to purchase insurance on online purchases at the point of sale. It's offered when and where people need it, and there is no need to go to a separate engagement with an insurance company. So some include singular policies, multiple policies created by several different agencies, and extended warranties. Next, we're going to look at investments and trading. So investment and trading embedded investing allows non-investment service companies to offer investment options that enhance customer experience and open additional avenues of revenue for companies. Traditionally, investing requires consumers to open a new account with a legacy financial institution such as Fidelity. One example is how consumers can now buy cryptocurrency from other platforms that they already use, and some of those include Venmo or PayPal. Then lastly, fintech as a service. So fintech as a service, while most embedded finance refers to embedding financial services into non-financial business processes, embedded fintech integrates fintech solutions into a financial institution's website, app, or other business processes. For example, a bank might also offer to help consumers get rid of unused subscription services or invest in cryptocurrency right in their own banking app, rather than having to download a new app and signing up for new services. Next slide.
Now we're going to look a little more focused into some applications that we can see how embedded finance is making a difference. Fast turnarounds are becoming the norm rather than the luxury. Standard expedited shipping, such as the 2-day Prime shipping, efficient chatbots, and specialized applications are just some examples of methods a customer get their needs met in a timely manner. Embedded finance brings financial services at a moment's notice, thus better implementing itself as a part of every user's daily life. Nowadays, we have hundreds of examples that we consider simple, essential apps that help us accomplish mundane tasks, which are in fact embedded finance systems. Some examples are embedded banking, embedded payments, embedded lending, and embedded investing. Looking into embedded banking, it allows for non-financial companies to offer their clients a branded checking account that can be used to hold a balance that can be then used for payments. This allows for faster and cost-saving interactions between the vendors and the customers. An example of this is Shopify's balance account, which allows store owners to interact directly with Shopify instead of having a bank in between, thus allowing faster access to profits. Additionally, it also offers Shopify branded cards with their own point system incentives and benefits that allow shop owners to grow their business. Similarly, we now look at the drive-share company known as Lyft that offers a checking account to its drivers, allowing instant access to their earned funds instead of waiting days for a bank to clear them. Similarly, it comes with a Lyft branded credit card offering similar benefits found in Shopify. Now we're going to talk about the use of both blockchain and embedded finance. Generally, almost all decentralized applications on the blockchain are embedded finance solutions as they connect with the world of digital currencies with fiat gateways, allowing users to pay for products and services. With implementation of blockchain, embedded finance applications can now seamlessly employ decentralized services such as Metaverse, allowing businesses to create their own unique digital outlets and sell both digital and tangible products. One main example here is PayPal. Since we can see that the merger of decentralized finance and embedded finance, once it started accepting Bitcoin as a means of payment.
All right, everyone, so now we're going to move on to the pros and cons of embedded finance. Starting with the pros, having access to the right financial tools is a must in modern society. It allows people to access the services they need and purchase products that they may not be able to afford in one lump sum payment. By offering bi-weekly, monthly, or other payment schemes, such microloans offer an important line of credit that encourage economic growth. This is especially important for clients who perhaps have larger credit, such as a mortgage, and are unable to get a loan otherwise. According to the Trending and Lending report, 39.37% of people are able to finance their purchases this way. The benefits of lending don't just end with the potential of consumers. A 2020 report by Mambu found that 88% of banks believe that embedding financial services into third-party platforms is important for their future success. Small and medium-sized businesses can also benefit from the introduction of embedded financial systems. Companies integrating financial services can generate additional revenue streams through fees, commissions, or partnerships with financial institutions. Embedded finance integrates financial services into non-financial platforms, making transactions and financial activities more convenient for its users. They can access banking, payments, and other financial services without ever leaving the platform. For businesses, this is a whole new service offering that allows you to directly connect your client with credit, whether it is in-house or through an intermediary. Due to the ties of having credit, consumers are likely to feel more connected to a business. In a survey conducted by FICO, 61% of US consumers said they would be more likely to use a financial product offered by a non-financial company, such as a retailer or a fintech company, if it was embedded in the company's app or website. Depending on the type of embedded finance your business is thinking of implementing, you may be able to reduce the risk of default. This is particularly the case for companies planning to offer embedded finance through third-party platforms or banks, in which case, the third party will handle all the transactions and the risk associated with them. Next slide, please. Moving on to the cons of embedded finance, there's always a risk of taking too many loans. With the increasing availability of credit, consumers may find themselves drawn to take out more smaller loans. Over time, these payments can build up for the consumer, and the consumer may find themselves in more debt than they bargained for and default on payments. While the loan may be issued by the lending provider, the only contact that the client has been with is the company. This may prove a challenge in case over a payment dispute or other issues. At the same time, a retail employee is not a lending advisor and may require additional training before encouraging consumers to issue loans. Handling sensitive financial data within various platforms raises security concerns. Ensuring robust security measures is crucial to preventing data breaches and fraud. Embedded finance involves navigating complex regulatory frameworks, which can vary significantly from one region to another. Adhering to these regulations is essential, but can also be challenging. Next slide, please. We're going to move on to the future uses of embedded finance. Embedded finance could offer advanced tools for personal finance management, helping users budget, save, and invest more effectively. Customized financial products like digital wallets, DeFi, accounting software, and many more. Embedded finance can enable the creation of highly customized financial products tailored to specific user segments, addressing unique financial needs and preferences. As embedded finance continues to evolve, addressing the associated challenges while exploring innovative applications will be crucial for its widespread adoption and success. Next slide, please. So here's a question for our audience. Considering the continuous expansion of embedded finance, what are your thoughts on the future prospects of traditional banks? Thank you.